Two things now. We were talking of
पानी और दे दीजिए
capital adequacy. आप भूल जाते हैं. Let me start with the first point. The strength of the bank's balance sheet is a function of the value of loan assets, and therefore capital adequacy was linked with the health of the, not strength, health of the loan assets, was linked with the health of the loan assets, and therefore they started with 8% of loans given, which was changed to risk-weighted assets, and since we were addressing credit risk, so risk-weighted assets basically was there because of credit risk. And the criticism was that in Basel I, we were not addressing market risk. What is market risk? The value of the asset, especially the investment asset. The loans do not have a market, and therefore there is something for the investment. That's why we have two types of assets. We have loans and we have investments. Investments are those assets which have a market. Theoretically, at least they have a market, which means that there is a market for them, and therefore there is a price, and the price could fluctuate. And if the price in the market on the date of balance sheet is lower than the book value that you have, you need to depreciate the value of this. The depreciation goes into your expense. Depreciation is an expense.
Profit and loss account.
Yes, as an expense, as a non-cash expense, but still it's an expense, and therefore it becomes it reduces your profit or increases your loss. Therefore, we thought that as on a balance sheet base, you have to take into account the market price, and therefore we had market risk, or what is easier to remember is price. And we had, this was Basel I, then we had modified Basel I. Actually, we didn't have 1 till 2 came, and modified Basel I said that we must provide for market risk, which means that this remains as it is, 8% of the credit risk in the loan portfolio, risk-weighted loans or risk-weighted loan assets. The second part of that is you go to the investment, you find out which ones have credit risk, you weight the exposure with suitable credit risk weight, add to the risk-weighted assets. So in the modified one, you had, in the original also, you had loans, risk-weighted loans, assets, credit risk in investment. This will take care of the risk, and you provide something for the market. You can have any kind of model, any kind of analytics, any kind of way of calculating. Since everybody can do it whichever way they want, again, Reserve Bank can prescribe. For example, they had a 2.5% risk weight on government securities and higher risk weight for non-SLR. It's very little, and I think 100% risk weight on the
2.5 only. I mean,
only 2.5% because
it's close to zero rather. If 100% is like, for 100% you have to have 8%. For 2.5 is very small, you'll have to.
Because by definition, government securities are not so volatile.
No, but if they're traded, then they are volatile, isn't it?
Not so widely volatile.
But it will be still 5, 6%, 10%. So if you take that even as the benchmark, 2.5 is very under.
Changed because of the studies on how volatile the government securities were. There could be. You could go back and try to find out.
No, I'm just thinking simple calculation. Because even if SLR, even if the public sector security, it's still the moment interest rate changes, it changes. So which is kind of a reasonably big number. I mean, it's not a very small number.
Reasonably big number, but the studies will show you that it's not so. You don't lose much on that. And that is number one. And number two, it's a book entry, because tomorrow it may come back. In this case, if there is a default, it's out.
No, what I'm saying is, suppose the interest rate is low, the bond will be higher. So which means suppose you have needed SLR has been whatever, you have to buy it. You buy at high price, interest rate goes up, and the bond price goes down.
Okay. Shall we leave this and go to something called classification of assets? Then you will appreciate this more.
Yeah.
Okay, we'll come back to this.
I'm just trying to think of this.
Yes, because you are thinking from an outsider's perspective, I'll have to think, because for us 2.5% was also too much.
I was thinking it was too less.
Yeah. I'll tell you why. For me personally, when they said 2.5% for market risk, I said too much. I mean, it's not necessary. Maybe as I said, back of my mind was that you are taking this total into 8%. This will be 8 into 2.5 into the exposure. Sort of a marginal variation. Yeah. But the major step that was there was the fact that all banks all over the world, through their representation in BIS, took into account that the market risk has to be taken into account. Now, if you see the development of banking, I have a problem there. What was done in BIS 1, and this is my view, I have not seen this anywhere else. Okay, now this is SPM class I am talking about. Why did we have Basel norms? Go back from that. Before 1985, say 81, 82, 85, till 80 at least, nobody even thought of capital adequacy. Nobody talked of you should have adequate capital. Everybody talked of stability of the bank, which is that your net worth should be such that the value of the bank, value of deposits is not eroded. Deposit erosion has not taken place, which means that till 80 we were thinking that some capital is necessary. The regulator will say if you have only so much capital, you can open a bank. You know, you had a filter, or you had a hurdle level. If the hurdle level, let's say you have a hurdle of 2 feet, whether the person is 3 feet tall or 5 feet tall or 7 feet tall, that's how the hurdle rate is. So once you say that to enter you have a hurdle, after that your bank balance sheet could grow to any size, and you kept capital whatever you wanted. Everything was deposit. Then we changed, saying that the risk is mainly credit risk. What was addressed to earlier, remember, was liquidity risk. Then we said there is a credit risk which is inherent in a bank balance sheet, which means that we will take care of that. The credit risk will hit the capital first. If the capital is eroded, then it will hit deposit. We don't want the deposits to be eroded, so you should have big enough capital. What is big enough? Then it became a function of the loan, of course. The credit risk, function of the credit risk, total risk that was there. And that was quantified, there were efforts to do a lot of quantification. Now, we moved from credit risk to market risk. Why? Because we felt, let's address all risks. Global risk management, global in the sense that all risk management became fashionable. Is it necessary? Can it be quantified? That is the point that came up in my mind. And we have been, people like who whoever has been at my age group or something, we have been discussing. Why? Because let's do a cost-benefit analysis. How much time, energy, money we are spending on addressing global risk? Okay. Can we address liquidity risk? Yes, we can, but not under the BIS. Under the BIS norms, we don't address liquidity, which is the inherent risk in banking, which is the age-old recognized risk, but we have what is called asset liability management for that. So liquidity risk these days is part of what is called ALM. That will be my last session on ALM. That is also very interesting. Second, credit risk is very important, and credit risk is from the balance sheet. ALM includes something else. The credit risk can be seen on the balance sheet, and it is a function of the amount here and the amount here if you are giving it to non-SLR bonds. SLR bonds is not credit. Now, just because we want to put in everything, we wanted to bring in market risk. Okay? At this point, I will go into what is called classification of assets. This is interesting because only then you will realize what kind of assets we are trying to deal with. The risk comes from assets. What kind of assets that we are dealing with? We leave loan assets. Loan assets are not reclassified, they are called loan assets. Classification of investment. This actually means classification of investment assets. The investment assets are of two classes: fixed income, equity. In fixed income, you have mandated, non-mandated, or SLR, non-SLR. I am using SLR in the terms here to be understood as government debt. This is non-government fixed income security.
If you buy a public sector share, that is not here. Huh? It's in the equity, no? Not in that.
All shares, public sector, private sector,
No
listed, non-listed, joint venture, everything. The issue is, now what is the basic difference between this and this? The basic difference between this and this is that this has a termination, this does not have a termination. That is, this has a maturity date, this does not have a maturity date. On the maturity date, certain amount is paid, which is fixed now. All cash flows are predetermined. Here, cash flows are not predetermined, and this is life of infinity. That's all.
But annuities, where will they classify? That is also possible there?
Yeah.
Annuities also, they have no end date. Huh? Or they also have end date?
Perpetual annuities are rare. Then you'll have to reclassify them. But they are classified under this. You do have government bonds which are called unrated bonds.
That's what I was thinking of.
Perpetual bonds, but very rare.
Not very.
Very, very.
Now I think more or less not
right
there.
now, no. Annuities banks don't normally invest in. If we discuss insurance, which I don't know, like people are trying to analyze balance sheet of insurance. Their annuity is a liability. They issue annuity. Banks typically don't enter into annuity. It's only a personal segment that annuities are. But yes, government had issued what are called 3% conversion bonds, undated 3%. They have not issued now. But there is a way of valuing that. There is no problem in that. So, cash flow discounted beyond a certain point, discounted significantly. What I wanted to say is, SLR bonds are for two reasons. One is mandated, the other one is over and above mandate.
A choice, basically, yeah?
Yeah, choice, but in addition to that.
Which will be like portfolio choice.
I want to keep it. Okay?
Especially in situations like this.
No, situations, you see what happens is, if I can't give loan, like these days, I'll buy it. If giving loans becomes, right now my feeling is that people are not taking loans and therefore I cannot give it.
There are both issues right now. One is people are not taking, the other is those who want to take,
are not credit worthy. That's the two issues. Yeah. You know, recession हो सकता है or people are not, I don't want to give. The second one could be, then it becomes a negative choice. No, I have money, I have nothing to do with it. So
like when you do multiplier, I have one slide in which I discuss 3 reasons when the multiplier doesn't work. One is that banks are not ready to loan, so the multiplier doesn't work. Then business is not ready to take loan, then also multiplier doesn't work. Third is people don't want to keep money in the bank.
Yeah.
It is like if the interest rate is very low,
one is interest rate low,
then it doesn't matter.
This side could be that the Sensex is high or the equity market is very low.
No, it could be like the liquidity trap situation, like presently in US and Japan. Stock market is down and rate of interest is virtually close to zero.
No, I have a problem with that. Quite a bit of the money which is in the bank is not only for interest rate.
No, that's true, but the significant part which is there, that suddenly goes back.
Yeah, but where will it go?
People keep it in cash. Because the thing is, I have no reason to. Japan, there are a lot of, if you read standard macro books, Japanese and Chinese society, for some reason, is still a cash society. The banks, people don't put money in the banks for whatever reason. They don't issue checks and all, they rather do on cash.
That is a different dimension.
And that increases further when you have an interest rate close to zero. I anyways don't have a habit of keeping in the bank. Now, if the interest rate is zero, I have even less incentive to keep it in the bank. Like all the time deposits, for instance, they will dry up completely, more or less.
You take India, for example, a lot of transactions take place through cash. So there is a lot of cash component, which I think data shows that the use of banking system is increasing slowly.
No, it is increasing, but the thing is, interest rate in India has been relatively high.
Okay.
So the opportunity cost of keeping cash is very high.
No.
If I keep it cash, I lose even that whatever I get from that. In the net, my real worth.
Yeah, I get your point, but if the way I am looking at it, let's forget the cash used for transactions. Okay. Let's presume that a high level of transactions are done through banks, like in the US. Now, if I have money, why should I keep as currency with me? I don't get any extra benefit by keeping it. Rather, I expose myself to carrying cash and keeping it there, which is safety measure.
That's another reason. Japan, since has a very low crime, that also.
To improve banking, you should have high crime.
No, that's another reason. That safety issue, which it doesn't bother the Japanese so much.
So, but why keep it if it is in the bank? Maybe they are not very sure of the.
No, the thing is, that you CASA, leaving on the CASA part, you take time deposits. And time deposit, if you see over the time, has much larger share than the CASA.
In fact, an interesting small study, if you want to look, is 2001 to 3, 99, 2000, 2001 to 3, interest rates were very low. Liquidity as measured in LAF deposits, at that time it was called repo deposits. Repo was huge. Only recently the record was broken. It used to be 120,000 crores. Now it's some 130 or 140,000 crores. Interest rates very low. 10-year bond, 10-year government bond 5%, 5 and 5.1%. Inverted rate curve now. But as you said, if the term deposits go down, the term deposits used to be 6%, 5.5%, 4.5%. So if his theory is correct, then the deposits should go down. The liquidity is wrapped in the deposit. The deposits should go down. My hunch is no.
Well, I think that there are two ways to look at it. One is to look at they may not go down, but the growth may substantially go down.
growth rate.
That itself is a reasonable evidence to suggest that now suddenly the growth was 20%, now suddenly growth becomes 2% or 3%.
Yeah.
That it means people are.
But unfortunately, those periods the stock market is okay.
But the thing is, that's a liquidity trap is a situation when the stock market is down and the interest rate is low. Then
That situation you should try to find out.
but there will be very few. Like Japan is one example. US is recently. India with 0% we getting.
Low interest, like 5% in India is a very low interest for 10 years.
See, another way to proxy this is make it a real interest rate to 0. Inflation is about 5%, interest rate also is 5%. There will be very small periods when this might have happened. So you have to take a series of the inflation rate and a series of the interest rate, which is on the say time deposit.
You'll have to clean it up and then do it.
Yeah.
Otherwise,
And see whether the real interest rate, when it's close to 0, does it have an impact on the
also,
growth rate of the.
Another thing that comes to my mind is that if interest rates are low, generally, I mean, my perception is, interest rates go down, stock goes up. The two are correlated, inversely correlated.
That is a normal situation, mild recession.
But why? Yeah, mild recession.
But if the moment is something like this, or the Japan 1989, the major crash.
Like for example, somebody asked me if 12,000 will it go down or is this the peak for the next 2 years, etc. My view was that it will go down a little bit and come up, go a little bit higher then come down. Because I feel that stock market is liquidity driven.
That's true, but you saw today the industrial growth figures are lowest in 16 years.
Yeah, but yesterday stock market has gone up.
That's what people are saying, that what is happening. But there seem to be complete dealing from the stock market and the real
estate. That is what can we study in India. I don't have time because I have meetings on 8 o'clock. But this I really want to do. I mean, if it is liquidity driven, can we take a proxy for liquidity? What we mean by liquidity and take the census and see what are the,
can be cleaned up.
Get 2-3 factors to see this. Why I am telling you, the story behind the econometrics exercise could be, I have money. Okay? Now, there are two kinds of money. One is for my existence. Not salary, khana, pina.
That's the transactionary precautionary demand.
Yes, transactionary requirement, precautionary, transactionary.
And the third is a speculative.
So when I cross that limit of transactional requirement, you are speculative. Now, if you give me, say, 4%, now interest rates are very low. 90-day deposit, that money I got, I put in 90-day deposit because I want to use it for something. I'm getting 3.5%, which is savings bank rate. Now, 3.5%, then I want to speculate. So this money could be going into speculation. Because one theory that is there, one idea that is floating around is that the bubbles were created by speculation. That's a liquidity-driven bubble. Now, America introduced liquidity and that gave rise to the bubble. So, if you can do a quick study of whether this is 12,000 or not, and if you arrive at a conclusion that this is liquidity-driven, then it is going to go up. Why? Because either it will be liquidity-driven or recession will come to an end and again it should go fundamental. Anyway, back to this. That's the banking. Now let me put some figures. Okay? You have 24% here. And let's say we have